Marginal and effective tax rates are an important distinction to make and something that I think it will really help you to understand as you start to think about retirement and that transition into it. It's going to help you make wise decisions as you decide between a traditional versus Roth contribution. It's going to let you conceptualize when a Roth conversion might be a good idea versus a bad idea. And at the end of the day, it's going to help you keep more of your dollars and maximize your life both now and in the future. And I'm going to take an assist from my daughter Navy and use her blocks to explain this concept of marginal versus effective tax rate. So let's start by defining the difference between a marginal and effective tax rate. So a marginal tax rate is the new dollars, the new income that hits what tax bracket is it going to be taxed in. So for instance, let's say these two blocks, let's say they fill up the 24% tax bracket, and any new dollars that get added, they're going to be taxed at a marginal rate of 32%. Now, does that mean that the effective tax rate is 32%? No, because the effective tax rate is just your total taxes that you pay divided by your total income. So in this case, the effective tax rate is going to be closer to like 19.5 or 20%. So that's the difference between marginal and effective. So now let's illustrate. Let's assume that these two blocks represent your income before you retire. And once again, let's assume that it fills up the 24% tax bracket. If any bonuses come along or commissions, they're going to be taxed at that 32% rate. Now, when you reach retirement, you're going to have all sorts of different income streams. You're going to have distributions from your 401k, from your pre-tax accounts. Those are going to be taxable. So let's layer that on top. Then you're going to have Social Security at some point. Layer that on top. And maybe you have some capital gains from selling investments. Let's layer that on top. But actually, capital gains, they're taxed a little bit differently. They kind of layer off to the side here and get taxed at capital gains rate. Now I'm going to take this back off. Now what you're looking at, you're saying, oh my gosh, when I retire, everything's going to layer and I'm going to be taxed at 32%. But remember, we have to take off two big blocks here. You no longer have your income. So all this that was filling up the 24% bracket, it goes away, and now your income drops. So if your marginal tax rate was 32% on new dollars, now your marginal tax rate, let's say you decide to take a big vacation. You're going to take a $15,000 European vacation, and you layer that on top. Okay, maybe now it's in the 24 or 22% marginal tax bracket. But guess what? Your effective tax rate with this is still less than when you had all this income from your wage income. So when we're deciding between traditional 401k contributions and Roth contributions, that's something we have to keep in mind, because if we are in the 32% bracket right now while we're working and we're deciding between a Roth 401k or a traditional 401k, then if I can turn some of this income, make it a little bit smaller by contributing to a traditional 401k, it's going to allow you to avoid that 32% bracket and stay at a little bit better 24% rate. So let's illustrate this a little bit further, and let's assume that you just retired and you are going to live off mostly savings for the first year of retirement. All right, you're just going to cover your shortfall. You haven't started Social Security yet. You don't have any pensions, and you spend $100,000 that you need for your lifestyle. So you're going to just pull that from savings, not a traditional 401k, just a savings account. Well, where does that go in your income stack? It doesn't, okay? It's not taxable. And so then you decide, okay, well, I'm actually going to pull next year's income out of my traditional IRA. So let's go ahead and do that. Let's represent that with this yellow block. And let's say that brings you up to almost filling up the 12% bracket. It's going to be $30,000 short of going into the 22%, plenty of room. We're safe from hitting that higher tax bracket. That's great, right? End of story. Well, if I'm your tax planner, that's not the end of the story, because I know that in the future, you're going to continue spending, and maybe you're going to have years where you spend more. Plus, at some point down the road, you are going to layer Social Security in there. So at some point, you are going to be in the 22% bracket. The point being that I don't want you to leave that much room in a very favorable marginal tax bracket. So I would be recommending that you either pull more out of the traditional IRA to cover even more expenses in the future, or even better, I think I would probably do like a $30,000 Roth conversion to fill up that 12% bracket. Now, once again, this isn't advice. It's to illustrate a point. I'm using blocks, so please don't go do a Roth conversion based on a guy playing with blocks. But that shows the importance of intentional tax planning and knowing the difference between marginal and effective. Because here's a scenario that I've seen a lot. Someone gets close to retirement, maybe within 10 or 5 years, and they start reading a little bit about some strategies they should be looking into. And one that inevitably comes up because of guys like me are Roth conversions. And so they go and they start reading about it, and they're like, yeah, that makes sense. Roth sounds really good. It grows tax-free, and I don't have any Roth yet, so I should start converting. But they're not retired yet. And so they are in those higher marginal tax brackets. And so they end up converting at a 32% rate or a 22% rate if their income's a little bit lower. And they could have avoided the 32 and 22 by waiting until retirement to do some of those Roth conversions. Now, keep in mind, there are scenarios where it does make sense to do Roth conversions while you're still working. It's just going to depend on what your individual plan looks like. So I hope this was helpful. And if you didn't catch last week's video on the traditional versus Roth contribution, go ahead and check that out. And until next time, have a great rest of your day.